Well, Canada's telecom stocks have been under pressure, but are there any trends which could help spark a turnaround in the sector? Joining us now to discuss is Vince Valentini, Managing Director for Equity Research at TD Cowen. And for full disclosure on companies covered by TD Cowen, a division of TD Securities, please see the link to the website at the end of this video. And Vince, thanks very much for joining us on the show.
Thanks for having me, Anthony.
All right,
I'm always scared that the sector's getting so beaten up that you will stop inviting me, but it's great to be here again.
We always love having you on the show. All right, so we just got through earnings season. What are some of the big trends or big takeaways that you're seeing there?
I'm going to give you two trends. One would be sort of related to the fundamentals of the core wireless business. The other would just be the tone from all these management teams. Let me start with that, because it is, I think, a bit of a turning point, I hope, for how these stocks behave over the next year versus the past 2 years, is there is a lot more humility and acceptance, if I can use those two words, from all of the management teams. These companies, especially the big three large cap names, BCE, TELUS, and Rogers, have kind of let themselves get off track a little bit over the last few years. Their debt leverage got way too high. Their free cash flow, in some cases, wasn't covering their dividends. And I think investors were just getting fed up with it. So you can't magically change the growth rate in your core wireless business. There's macro dynamics and population dynamics and price competition that will take some time to work itself out. But what these management teams can do is control the controllables. And that's what we learned a lot about, both in the Q1 sort of earnings season and also at our conference, May 14th, which we host every year. A lot of good detail from management about here's what we're doing to fix the problems, whether it's dividend cut from BCE, which was actually well received because it now sets them on a stronger foundation, selling towers, selling some of their healthcare business in the case of TELUS to get their debt leverage down, Rogers being a little bit more open about what the plan might be to monetize their sports teams, which is a huge pocket of potential cash to help their balance sheet and as well surface value for shareholders. So Anthony, yeah, I think the biggest takeaway, and we'll probably dig down into some more of those points in a second, but the biggest deal, I think, is these companies being a bit more transparent about what their plans are and starting to execute on some of those plans to build a better balance sheet and a financial foundation. The other takeaway is not quite as rosy, but it's not really unexpected. We knew that the first quarter results were going to be a bit messy in wireless. We saw material declines year over year in subscriber growth, largely related to the new immigration policies in Canada, which started to take hold in the second half of last year, but this is the first quarter where we really saw a really tough comparison when there were still very high levels of immigration in Q1 last year, and that went to close to zero in the first quarter of this year. So big drop in sub ads. No really worse than expected, but still a tough hill for these companies to climb. And continuing a bit of challenge in terms of pricing. I think the pricing dynamic is stabilizing, but even price changes and promotional discounting that would have happened a year ago is still gradually filtering through the reported numbers. So Q1 from a wireless fundamental perspective was a bit challenging, a bit of humility on the balance sheet side. We can turn our attention to Q2 in a follow-up question and talk a bit more detail about it, but I'd just say briefly that the signals we're getting from the companies, and we're now obviously just over 2 months into the second quarter, are that the second quarter is a little bit better than the first quarter. Not quite as precipitous a drop in subscriber growth, still down year over year, but not to the same sort of 60% magnitude we saw in the first quarter. And pricing has remained reasonably disciplined throughout the first 2 months of the period. So touch wood, there may be a bit of light at the end of the tunnel on the core fundamental side, but I think most of the investors are more focused on the balance sheet stuff short term to at least create a better foundation. And then when the fundamentals start to turn and there's better growth, companies will all be better positioned to take advantage of it.
All right, that's a great overview of the first quarter. Let's dig into some of the themes on your radar, and starting with repricing of wireless subscribers. What are you seeing play out there?
So we've done some work recently and published on it of trying to put some math around what percentage of the subscribers in Canada have already repriced. So we've basically been in a price war for 2 years. The big deal where Rogers acquired Shaw, and Shaw then had to spin off its wireless business to Quebecor. So Quebecor has been running Freedom Mobile ever since. That happened in April of 2023. So we've lapped 2 years on that. And a price war pretty much broke out within a month after that happening. It wasn't all Quebecor's fault as a new entrant. It was sort of preemptive, retaliatory behavior by Rogers, Bell, and TELUS. So what we've tried to do is predict, if we look at how many subscribers have been added over that 2-year period relative to the base of current customers. And we can try to triangulate how much of this repriced pain is already behind us. Our math suggests we're in the range of 60 to 65% have already repriced, which is good news. So most of the pain is behind us. We think there's probably another 6 to 12 months of the lingering effects of the price war to come. There's debate in the industry amongst analysts and amongst some of the management teams as to what percentage of total wireless customers in Canada will take advantage of lower prices. I mean, the fact is, if you go out and shop around, if you're paying $60 or $70 on wireless, you can probably find an equivalent plan these days in the $40 to $50 range quite easily. And if you want to move to a flanker brand and maybe take a slightly lesser network quality, you can get yourself down to $30 to $35 at times. So what percentage of people will actually do that versus those who may just be complacent? Some management teams think it's, we're almost there, that only 70% will reprice and 65% already have, so which means you only have like 1 quarter left of pain, and then things will start to turn up in terms of wireless pricing and that key ARPU metric that drives wireless service revenue growth. Some people, myself, think it's probably more in the 80 to 90% range, so which means we probably have closer to another year of pain to go through. But however you slice it, whether it's 1 quarter or 3 or 4 quarters, we're definitely closer to the finish line than the beginning of this painful process. And once everybody's repriced and everybody's happy with their plan, things would start to stabilize. We still have to worry about, when will population growth and immigration come back so that subscriber growth can reaccelerate a little bit. That would be nice. Nobody's seeing that or predicting that just yet. But the price component of service revenue, I think we are getting closer to the end, and some analysts are even getting optimistic that 2026 will be a pretty big inflection up. We haven't quite made that call yet. We want to see a little bit more evidence, but yes, the percentage of customers that are repriced is becoming critical math with investors right now to know how much longer we have to endure this sort of painful, slow revenue growth environment.
Now, another thing that you highlight in your reporting is you identify non-core asset sales as a theme. What is driving this trend?
So back to the humility and acceptance earlier, Anthony, it is everybody realizes their debt leverage got too high. Everybody got there for different reasons. For Bell and TELUS, they were spending billions of dollars on capital expenditures to upgrade their networks to fiber over the course of 10 to 15 years. Plus, they did some acquisitions. For Rogers, it's really all about the Shaw acquisition and funding that $26 billion deal, mostly with debt. But whatever way they got there, they all reached the same spot where their debt leverage is nearing 4 times debt to EBITDA. In the case of Rogers, it got even higher than that temporarily after they acquired Shaw. And people just aren't comfortable with that. With interest rates aren't at the historic lows they were 5 years ago. You do have more competition, which has slowed down sort of your cash flow growth. So I think investors have said, look, investors and credit rating agencies have said, 4 times is just too high. You need to get yourself back into close to 3 times debt leverage, and there'll be a lot more comfort that there's that solid foundation there, that then you can afford your future CapEx, you can afford your future dividends, you can afford, if another tuck-in acquisition comes up, you can do it from a position of strength. So that feeds into the non-core asset sales, that is one of the biggest ways these companies can address that problem, is say, look, we have built up all kinds of things over the years that we don't, in some cases we don't need to own at all, or in some cases we don't need to own 100%. So in the case of Rogers, they sold, they're in the process of finishing a deal to sell off 49% of their wireless backhaul infrastructure to Blackstone for $7 billion. It's probably the biggest deal in the space. A bunch of them, BC and Rogers both have sports teams that they can monetize, which don't really generate any cash flow, and those are on the list. I mentioned earlier, TELUS has identified their cell towers as something they may partially monetize. They also own a very big healthcare IT business, which they're not going to sell the whole thing. It's core to their growth strategy, but they don't necessarily need to own 100%, so they could bring in a minority partner and monetize some of that. So we've actually published that there are 13 different, I won't go through them all here, it would take up our whole half hour, but 13 different potential non-core asset classes across Rogers, BC, and TELUS that could get monetized. And they're all in the process right now of trying to pick and choose what is the best to monetize, and I'm sure they're out negotiating as we speak to try to see where they can get the best deals. But that's going to be a very key thing that's already started and will continue throughout this year, and investors very much want to see finish to that process to see who can execute the best on these deals, get that debt leverage down to 3 times versus 4 times, and then we can be much happier about the backdrop for these stocks going forward.